live. We're a little bit delayed this morning. We had some cameras freezing, a little internet connectivity issue.
We might be talking into a video version of the Creed Thoughts blog right now.
That's
We
right.
don't
Yeah.
know.
Yeah. Cory prefers it this way. The man was very nervous to have me live just broadcasting. Like, that is the funny thing, Cory, I've been thinking about is like, we're literally broadcasting to the entire world. The entire world.
Yeah.
Yeah, so I see why you're nervous. Anyway, welcome everybody.
Anything.
We're gonna
Well,
talk. We've got a unique topic today. I'm just gonna roll it out a little bit. Cory and I will chat, allow a few other people to join us on live stream. But today we're gonna talk about what the last couple of weeks taught us around market timing. And then we're going to dig into a little bit. For those of you that aren't market timers, have already set that discipline aside. You're no longer tempted by speculation, market timing, and gambling with your hard-earned capital. Then just enjoy the first half of the episode. The second half of the episode, we're going to get into where the media can lead us astray, even with their well-intentioned financial advice. So, sorry, Cory, I didn't mean to...
Well, for those of us that think we're not market timers, understand that second half will show the media has lots of ways that they'll convince us we're not market timing, but still falling prey to some of those emotional pitfalls of investing. So I think everyone could go into this with an open mind and be well served.
Absolutely, man. Couldn't agree more. I just realized here we're going to talk about market timing, Cory, and I'm only now getting open the S&P 500 chart that our audience is going to so enjoy. It's open now. These are some of the challenges of us doing live streaming. So let's just talk a little bit about what is market timing. So Cory, just roll that out in the simplest form of what is market timing as it relates to what people are listening to now or what they could be tempted into doing during turbulent times.
So it comes in a lot of different flavors, but the most basic form is, should I be in the market or not right now? Like, when's the right time to get in and get out? Or I'm already in and I think something's going to go bad, so I think I should go out so that I'll miss that downturn and then be able to get back in and only participate in the upturn. So that's a great way to say it. Attempting to be absent for as many downturns as possible and only be there for the upturns. But it's a tricky thing because you have to be right about several things in short succession. You got in, but then you have to be right about when to get out and when to get back in again. But then it's never ending if you're playing that game, because you're always trying to pick those right times.
Well, and as all of you are listening today, here's what I would have you consider or think about. And that is that we're tempted to, as Cory said, avoid the downside. That all we want to be able to do is protect what we have. We know that psychologically speaking, the threat of loss is far worse to us than the benefit of gain is. All things remaining equal. Psychological studies show this all the time. And here we stand in one of the most unprecedented years. Like, I don't think we have to log all of it out, but everything from people thought we would end up in another war with Iran earlier this year. I know it seems like a million years ago, but it wasn't that long ago that we killed one of their top terrorist leaders, and we found out that another one in a joint U.S. operation was killed in August, but we're just finding out about it now. We have a worldwide pandemic that's taken countless lives. We have a change in presidential power in the most contentious presidential election ever. And on top of it, we have stock market prognosticators saying, here's what we think is going to happen in the market. Now, so as you sit back and reflect and just think about it, you think about that year, this last year, all of the events that happened, how tumultuous it was, countless amounts of layoff, countless amounts of stimulus dollars, like across the board, and put yourself back in January and say to yourself, what do I think? If somebody could tell you with certainty, absolute certainty, God Almighty himself lifted up the roof of the edge of your house and said, here are the events that are going to happen in 2020. Now, what would a reasonable person say about what the stock market would do? You're a reasonable person. And what would you think the stock market would do over that year? If somebody was able to say a pandemic is going to occur, these things are going to happen. We'll have a change of leadership. We're going to have 3 new Supreme Court nominees. All the things that could seem like either a big win or a big tragedy, depending on what side of the political aisle somebody's on, that have occurred this year. And they accurately gave you every detail. What should the stock market do over that year? Well, I think most everybody who's reasonable would say, well, I think the stock market's going to be absolutely hammered and punished.
Just have one of the worst years ever is what that seems like. Yeah.
Indeed. And here on this podcast and others, that's not what we were saying. But let's just take a look at the S&P 500 this year to date. So my apologies.
By the way, we weren't predicting that the market was going to have its best year ever either.
No, exactly right.
That's not what we were saying either.
Nope. But here we go. Jordan, get a little confirm my screen sharing like it's supposed to. Yep. Got a thumbs up from Jordan. So here we started at the beginning of the year. And here is our big drop off in the S&P 500, which at its depth was down 30% from January 1. It's down more than that from the high that occurred in February, but down 30% as of March 23rd. And where it's huge.
Isn't, for those watching, that's the scale of this graph seems deceiving a little bit, because it didn't really go nearly to zero.
Oh, yeah. Right? Yeah, the zero on this is about 2250 in the S&P 500. Yeah, we can see it here. Yep, and that's a great point. Just the little ways it's, for instance, if I just quickly said, well, let's just look at 5 years, you can see that what happened and what we were telling clients right about here is the stock market's been absolutely on fire for the last, 3 or 4 years. But you could buy in at 2017 levels. Buying the stock market on a discount like you're buying it in 2017. And for the people who did that, not based upon they thought this rally would occur beyond the recovery, but just saying, hey, those are discounted levels, or as we told our clients, when you see a sale at your favorite department store, say it's Nordstrom's, and you see that a suit that you already own that you paid $1,000 for is now $500, is your first proclivity to run home
panic
and sell all your other suits who may have also gone down in value? Of course not. If you loved Jaguars, that's just your car, and you hear Jaguar's resale value is dropping tremendously, we know that when those prices drop, our natural proclivity with every other kind of item is to do what? Take advantage and acquire the thing. Not if you don't need it, but if you're like, well, I got a couple of suits that are threadbare, I guess I can go ahead and spend $500 and get a new suit. Now, totally fine.
Paul, what would you say to the person who's listening who says, that's all well and good, Paul, but I may have just bought the suit that I'm likely to be buried in. Like, I'm not buying a lot more stock right now. I'm living off of that money.
Yeah, absolutely. And which is a great reason to say, if you've got the suit that you're going to be buried in your closet, you're happy. You don't go home and sell that one for sure.
Well, yeah.
Because you're almost guaranteed to have to reacquire it at whatever the new market prices are. Now, we get that as it relates to a car or as it relates to clothing, but many, many people made bad decisions. We had clients that wanted to make some really bad decisions at that downturn. We were able to save all but one of them. And now they've watched the market recover. Now, what was it your friends at Your Business, Your Wealth and Sound Financial Group were saying at the depths of this? You're buying at a discount. The market will recover. And we thought it would recover by year end. So we were wrong. I thought it would go down. Bump. We talked about the red Solo Cup. We were dead wrong. By the way, we're dead wrong like everybody is when they do this. Now, we were dead wrong on the optimistic side that the market would come back by year end, that we would bump along the bottom, and between therapeutics and vaccine news, we would recover before year end. And sure enough, that's what's happened. Now, we've got some concerns about whether or not there's stimulus, additional shutdowns, second wave, etc. But let's just take a look at the presidential election. So I'm going to show you here. Let me go to this date range. And what we're going to do is pick October 28th, sorry. October 2020 on the 28th, that was one of the lower opens right before the presidential election. And so sure enough, people said, oh, yeah, I better get right out of here. Look, it dropped, how much it dropped right at the open. And yet, where do we stand now? As of this morning, the market is up 6.13% in a matter of like 3 weeks. Now, here's what I would have all of us take away. Now, of course, if you have an academically allocated, globally diversified portfolio, it's not the Standard & Poor's 500. But the Standard & Poor's 500 is an indicator and an easy one to look at about how impossible timing the market is. Because let's do something here. Cory, we didn't talk about this before, so the danger
you go
of
back
Cory
to
being
that
on live stream.
For a second, just because let's remind everyone, we didn't have any sense of who our next president might be until the 9th, 6th to 9th. And surprisingly, there's some folks there's still some conversation around that, although it's going more and more in one direction. But even in that uncertainty, the market was going up. And that's really my point. It's not about elections and choosing presidents, but that we really didn't know, and the market was still going up. And a lot of times people talk about the uncertainty of elections pushing that down. Now, I have no idea why that was happening. And anyone who tries to say they do really doesn't either. But my point is, anything can happen.
Anything can happen. And the key is, it's the anything that happen, and it happens fast. It's fast.
Yes.
It's unpredictable. And it happens, like we're going to talk about in a minute, with news, and you will see, like news. So the definition of news is something new. That's why it's called news. And that news was information that was unknown or unknowable prior. And the unknown and unknowable is what moves the market when it's now known. And I will never forget when I was at a conference, Cory, this is like 16 years ago. And one of the business coaches that I've followed over my career, we're at a conference for him, and he said, talking about active investing. And he said, what we're going to do is we're going to simulate what happens in the stock market. Keep in mind, this is 15 years ago. He says, a new piece of information got released right now. And then he looked at his watch for 6 seconds and looked up, and he said, the price of that security has adjusted already. That was 6 seconds 15 years ago.
And today,
yeah, I don't know how much faster it is, but I know 6 seconds was too short for any individual investor to do anything about it 15 years ago.
Well, there's a great book called Flash Boys by Michael Lewis, who wrote most notably Liar's Poker and The Big Short, Moneyball. Yeah, some major movies have been made from his books. Flash Boys is about a lot of different people in Wall Street and finance, but a big theme of that book is a company that's putting a fiber optic cable between New York and Chicago
for billions of dollars of cost.
Billions of dollars of cost to make it feet shorter, to make it microseconds shorter transfer speed of data between those two financial centers. So it's probably not even getting through half of that sentence that guy was saying now before it adjusts.
Yeah, like at now.
Right.
And now it's not only that, but if we think for a second that the best and smartest minds in asset management know what General Electric, Tesla, Ford, Microsoft, any of these companies are going to do in the next 2 weeks, then why do those same companies spend billions and billions and billions of dollars on shortening a transaction this much in speed so they can profit fractions of a penny over and over again if they could tell us where a stock price is going to be 20% differential in the next 6 months? Now, here's the thing. I'm not saying that that's impossible or that no one could do it. But here's the reflection I would have all of us make. I want you to imagine for a moment that you could do it. That you knew and you were 100% right every single time where a stock was going to move. Maybe some weird superpower, like something out of a Marvel series where somebody, all they have to do is open up like the old New York Times with all the ticker symbols, and all of a sudden the data transfers for them and stock symbols pop out. And it's like a blend of the Da Vinci Code and something about the paranormal. And suddenly he's able to... You've got this amazing ability. You picture this of you flipping through the pages or looking online, and they light up to you and you buy them and they always go up. Would you allow strangers to invest with you? Or would you move off to an island by yourself with your close loved ones and family members and continue to crank those returns year over year over year? Well, of course you would choose the second option. So I'm not saying nobody can do it. Just that nobody who can do it is telling you. Yeah, they're not telling you. They're not telling me. They're not telling anybody. You know, even I was looking at the famed hedge fund. I don't think I have this article pulled up, but the famed hedge fund of Bridgewater Associates, they're not, I forget, it's called Alpha Cap or something. The real big flagship one. Well, its long-term rate of return is like 11 and some change with an extraordinary amount of risk. And the all-weather portfolio that's often touted by folks like Tony Robbins, et cetera, has a long-term history of 7.3%. Not bad. Not bad. But we're not. This is one of the wealthiest men in the world who's viewed as a stock market prognosticator. And he barely outperformed index investing over the last 20 years. Well, like by fractions of a percent, not even a full percent.
Remember that this, I mean, it's an incredibly complex market, but it is finite in size. So even strategies that start working only have a certain limit to the amount of money that can be at play in that strategy before it stops working, because, you know, there's only so many shares of Microsoft out there. There's a lot, but if you're someone who has that magic mutant gene about stocks, there's other people that want to buy it for other reasons. There's only so much you can get at that. It's not like you could do this with billions to hundreds of billions to millions to trillions of dollars. Like there is a limit as well. And then if one person had that mutant gene to do it, people would, if they started to notice and started to copy them right after, that starts to decrease the efficiency of that strategy for everybody at the same time.
Well said. So here's the thing I was starting to go down the path of before.
Is that all the way back when I was like, oh, wait, can we go back?
Yeah, that's right. Yeah,
Love it.
Before Cory said something valuable and reasonable, but what he was interrupting was my rabbit trail.
Nice.
So here's my rabbit trail. Let's go look at the year-to-date performance of the market. Now, to put this in perspective, I'm clicking back to the other screen for a moment. Remember that the S&P 500 is up. I'm sorry, I think I hovered over it. It said 6 earlier. I guess the market's on a tear. I wasn't quite all the way right. 8% change since October 28th. Okay. Now, since January 1, the market in total is up 11.43%. So I'll do some quick math in my head, but basically it's like of the returns you would have had, 2/3 of them occurred in the last 3 weeks on the entire ever-loving year. So I want to say that again. In the entire, this is why I do enjoy being able to do these live streams, is we can talk about things that are happening right now.
Right now, yeah.
And what's happening right now is that if you were out of the market the last few weeks since pre-election, and you did it for all the right reasons, you forfeited an 8% rate of return. Now, let's go the other way. Let's say the market had gone down 8% after the election instead of up 8%. What would our strategy be to recover? Rebalance if there's a significant downturn, add money if we have some on the sidelines, and hold strategy. That's the strategy for recovering losses.
Which means you're selling disproportionately less of what's stayed strong and buying disproportionately more of what has gone on sale. That's the beauty of rebalancing.
And now, as of today, in fact, let's just do this. I'm just going to shorten this down to January 1 to October 28th. So we'll just look at the year prior to this, just so nobody thinks I'm doing any fancy internet magic on a live stream. So from the beginning of this year through October 28th, when our market timer hypothetically sold, it was 1.25%. So I was wrong, Cory. You missed out on like 650% of your total rate of return for the year if you were out of the market the last 3 weeks. Now, here's the thing. Now, people will see that, and they may even do it with their own investing, and what they will do is chalk it up to the stock market not working. This is the equivalent of somebody putting their underwear on the outside of their pants, their socks on their hands, and wearing no shirt. And then going out in public and being like, man, just clothing doesn't work. Like, people just look at me weird. Like, if you do it wrong, it won't work.
Well, it's not that the stock market doesn't work for us. It's that the human brain usually doesn't work well for the stock market.
And it served us so dang well, the human brain, for so many years. When we needed to predict patterns of like, oh, you know, the sun's getting longer in the sky. It's the peak of summer. We need to think about harvesting in another, you know, X amount of sleeps, as the kids would say. Yeah. How many sleeps until we harvest? And then you would look at weather patterns, and that pattern recognition served us incredibly well. That pattern recognition doesn't serve us when it comes to the stock market. Now, we've talked about this a lot, especially since March, with the concerns around the pandemic and stimulus and stock market volatility. The bottom line is, it is this volatility that scares people away. And it is this volatility that triggers the biggest wealth transfer ever. And it happens nearly every year, where people get scared about something, sell out their positions, and who profits? Those of us that stay disciplined. Now, I'm not a big fan of the government doing anything that produces any kind of wealth transfer, but free market wealth transfer is okay because you opt into it. Like that person, that client that we couldn't save that I wish we could have, right here, March 23rd was the day they lost their stuff. Had a tremendous hit to a 7-figure portfolio. And due to people being in their ear and saying that strategy isn't working, you got to get out, it's going to zero, you're going to lose everything. On the fear of losing everything, they lost a third of everything they'd built. Meanwhile, if they would have only held strategy, in fact, if they had held strategy and added money, they'd be up by a good margin now. And that's it. So I want you to know, as you're listening to this and you're thinking about your portfolio management strategies, this is what we do. I was able to take a chunk of money out of the business this year. And what I did is, and it took some effort, like I had to wire money and get it in time. And I had the money to invest. And like we talk with all of you to do, is like when it's prepared, I put it in. I didn't dollar cost average it over the year. I didn't do any of those things. I just took an extra $200,000 and put it in on Monday, right before the election. And I didn't know what was going to happen. But you know what I did know? Is that I need millions of dollars of capital at work for me to be able to have the choice to be done by age 46. That's my wife and mine's plan. Not that we're going to walk away from the business, anything like that. We just want the choice to be done.
Good. I was like,
by 46.
We had
well, I tell
I don't know
Jeff,
if that's in the partnership agreement.
I said, Jeff, I think by our estimates, though you didn't meet us till your late 40s, you probably achieved it right around 47, 48. That you, Jeff Miller, for those of you that haven't met him, you can listen to the episode on the Millionaire Next or A Millionaire Next Door. And I said, I just want to beat you by a little bit. So, but the thing is that I just put my money in. It could have just as easily gone the other way, but it's not going to affect my asset values in 20, 30, 40 years as I continue to live on that money. And what I'm doing right now is practicing the mindset that I need to foster in my old age. If right now, while you're earning an income, maybe you're in the top 1% of household income earners and you're still freaking out about the funds that you will not access for years to come, you just got to spend more time training yourself, more time exposing yourself to your coach and advisor in this kind of data and information, because everybody else is going to tell you can time the market. And they're either telling you in a cloaked way or an uncloaked way. The cloaked way is, oh, you don't want to do it yourself. There's too much going on in the market, etc. Invest with this active asset manager over here and they will outperform the market. So they're not saying you could do it, but somebody can. Now all the discount trading platforms are saying you can do it, but they're both making the same argument. Somebody can time the market, though this is like one of the biggest frauds pulled on the American public by big box financial retail. And that is that anybody can do it. Every academic study, the only studies that kind of hint that maybe there's some inefficiency in certain publicly traded markets that would allow you to be able to get some additional return or some asset manager to get additional return, the only studies showing that are from the people selling that service. All the academic studies point over and over and over again that the market is too efficient, that there's too much information being communicated in the prices. There's no way a human being or even a computer program currently can even keep up with it, predict it, or consistently or predictably produce outsized returns because of quote unquote information they have nobody else has. It is a hoax. It is a fraud. It's not real, but it will seem real in the moment. It
is kind of like the health studies commissioned by the tobacco companies on cigarettes.
They help you with your breathing, especially the menthols, Cory. They're super good for you. So while we're talking about the conspiracy of big box financial retail, let's spend a few moments talking about how the media can lead you wrong. Is my screen still showing? I've sort of just been jamming along. Okay. Do I need to hide this thing that says hide, or is that not going? That's not showing? Oh, good. Well, look at us figure out our live stream right in front of everybody. All right. So this is great. Here's the article. We were going to pick on several. We went a little long on the market timing, so we're just going to look at Personal Finance 101, my favorite, the complete guide to managing your money.
Ooh.
It's complete, guys.
And it's only a 17-minute read.
This is all you need.
I'm faster than average on reading, so I'd probably get through it in 15.
You could 10. Totally read it twice in 17 minutes. So, in case you needed additional help in reading a 17-minute article, there's a tip.
Okay.
Just forgive me.
We're just having a little fun. We're feeling a little punchy, guys. This is maybe punching below the belt, but I don't even care. It's funny.
Hey, here's the thing. Cory, feel free to disavow me at any point during this. This guide lays out 7 key steps to focus on to get you working toward long-term financial security. Follow along from start to finish or jump to the sections you want to learn more about.
Thank you.
Here's the thing. Maybe a tome like Free to Choose by Milton Friedman. I need a guide on how to read that. I need a guide on how to read the Bible. Maybe even a guide on how to read a book like Atlas Shrugged or Ken Follett's Pillars of the Earth. I don't need a guide to walk me through how to read this article. Okay. So we're going to talk about a few things that probably aren't too bad. Like you should set short and long-term goals. Fine. I accept. No problem. That's a good thing. Create a budget. I'd prefer that they go with spending plan, but that's semantics.
Yeah.
Good. So far, so good. Which, by the way, most of these personal finance articles and gurus get those first couple of things right. Like maybe you should have some money set aside for emergencies and you should save some money. There's your emergency fund. How to create a financial cushion. You keep money in cash and don't spend it all. I don't know why that's a minute long, because I should have taken 3 seconds. Okay, so you're right, Cory. I am a little punchy.
Right.
My bulletproof coffee has my brain on fire this morning. Pay off costly credit card debt. So far, we're in agreement with them. But these aren't the things where people go wrong. You should save for retirement.
I will actually say I appreciate that they put a savings cushion first before paying off credit card debt. Many sites actually put that the other way around, which leaves you in a really tough spot if any emergencies happen. So, so far, so good.
Okay, good. I'm glad you got that out, because so far isn't going to be so good the rest of this article. So let's start with this. Now, what we're going to do is let's just use, they're going to talk about a 35-year-old. So save for retirement. And here is where we start getting these formulas that don't make sense on their face. But maybe like a lot of things we read in the news, it takes a moment to sit back and just do some simple calculations like, is that even real? So let's check this out. So if we have a 35-year-old, and let's say they're doing pretty good, they're making $250,000 a year at age 35, which then, according to them, says we need to have 2 times our annual income. Oh, and it even gives us the other numbers. And this is great because they're also sprinkled throughout the article, Cory. I didn't realize they were all next to each other. So I will scroll through the rest of the article and do my best to besmirch how big box financial retail and the media tend to work together rather than people being reasonable and just learning and thinking about money. I will still do that, but we can do all the math at once right here. So let's cover this. So we got somebody with $500,000 and they're 35 years old.
That's
they're making
2x their
$250,000
salary at 35 for anyone who's, especially if you can't see it.
And let's say we just have a growth rate of 7%. Yeah, thank you, Cory, for taking care of our audio listeners. In 30 years, by age 65, that would be $3.8 million.
Without adding anything to it.
If you added nothing to it, and you also, think about this, you're a household making $250,000 a year when you're 35, assuming that you never get a pay raise, that might work. That might work. If it was all in tax-free accounts, might work. But let's just look at, if this person just got 3% income raises, so we're taking their $250,000 annual income, and we're adding no money to it, and we're just going to use 3% inflation for 30 years. How much money were they making right before they needed to punch out? According to this plan, $600,000 a year. So we're going to go from $600,000 a year of income down to 150?
150, yeah.
150,000 of income from 600.
That's the 4%
that's not gonna work.
rule on 3.8 million, roughly speaking. If anyone's doing the actual math on their calculator, you can put it in the chat box and give us even more refined number, but I think that's close enough.
Indeed. So one of the things it talks about is you put money into retirement accounts, Roth, etc. Now, one of the major problems that we see oftentimes is most all of the advice assumes that what you want to do is work from 22 to 62. And you don't want to punch out any earlier than that, because one of the biggest recommendations they make is just throw money into qualified plans only, with no conversation of you might want some freedom, access, availability of capital for a myriad of reasons before your age 59 and a half, which could go out further. We just saw them in the CARES Act bump out the required minimum distributions. We may see distributions from retirement accounts have their dates moved also. Not soon, but I'm saying that as people live longer, it's inevitably going to adjust. So start saving 10% of your gross income in your 20s. And where is my amount that I'm supposed to have in each one of these? In your 40s. Oh, well, instead of scrolling through the whole article, which we will have in the show notes, let me go back up here. In your 50s, you're supposed to have 6 times your salary when you're 50. Okay? So let's take our 50-year-old person. This is where you're going to see just these quote-unquote rules of thumb. Don't follow a damned one of them, guys. And the reason you don't want to follow them is I think it's great to use them as a guide, but then you've got to learn to do the math. Because you can do the math, and right here, if we just let the money grow, we might be okay. In fact, if you had 2 times your salary, again, this person's making $250,000 a year. if they save 20% of their income for 30 years, let's just look at this. If they continue to do that, their net worth would be $8.8 million, giving us a retirement income stream of about $350,000. And that might work to retire if our pre-earnings were 606, but look how their math changes. Now, when I'm 50, I got to have 6 times my income. Well, let's just go, if we're going to go to 50 from 35, how much are we making at that 3% increase each year? So we're making 389. So what do they say, 6 times? Cory, can you do that math?
6 times
389?
389.
Should be like 2.3 million, I think.
2.334. Yep.
Yeah, that's pretty far off. 2,334. Now, I'm not going to save any money because they're not talking about the savings rate there. And I need to back it down to 15 years because that's how much longer we have to age 65. And that leaves us with 6.4 million. 6.4 million based upon the fact that we are going to have a total income of $600,000. So far...
Wait, their math is actually scaling down as you get older, not up.
That's what I'm waiting to watch for in the chat. Yep, you're exactly right. We actually have less money now than we would have. And now just look what happens. By your late 60s, having 10 times... Late 60s? 10 times your annual... Sorry,
let me say this again
until you say that.
Let me say this again for everyone that's listening. The math that they're using is not changing the numbers to chart you staying on the same path as you get older. The numbers actually change to have you on a lower path as you get older, depending on when you start thinking about it, which is strange.
And I've been seeing these numbers pop up a lot in personal finance articles across the internet over the last 18 months to 2 years, and there is no basis in reality for them. Well, number one, we've talked to you guys on previous episodes that you shouldn't should all over yourself. I should do this, I should do that, but don't let these folks should all over you. You should have this, you should have that. How about how much is required for me to have the life I want? How much is required for me to give my children the education they deserve? How much is required for me to give to the church based upon my faith? That's the numbers I want. I don't want to have myself or anyone else should all over the place. Because here's the thing. Remember, we just talked about the person making about 300-some thousand, and they're on schedule to have, I'll be darned, about 20 times that at age 65 based upon the numbers in their 50s. But now, guys, I don't even need to do the math on the screen. If you're in your late 60s, 10 times your annual salary is by definition only going to provide you like 40% of your pre-retirement income. Now, if you're one of those people, a little bit like me, live radically within your means, you don't spend that much money, you save a truckload of money, well, then that works. Because when I cross the threshold of financial independence, I will be living on a very small portion of my overall income. But that's why the capital at work can do the job and I can have the financial independence.
But they don't say anything about that in this article.
Not even a little bit. In fact, based upon this article, as long as my income didn't rise too quickly, I could just sit on my laurels based upon what I had set aside at age 35. And according to their article, I would be on pace to be fine, retiring at 40% of my pre-retirement earnings. This is the complete financial guide. And one more thing to watch out for, and this is not meant to pick on CNN, but I think is a funny way for us to end this today. In searching for some additional articles on this, I found this new website called CNN Underscored. And what it appears to be is a website that primarily focuses on reviews of gadgets, wellness, money, travel. And so I was like, let's see what CNN Underscored has to say about money. And I'm just scrolling through here, but here's what I want you to notice. Everything we're looking at so far is totally based on spending. everything is spending related. There was one down here, like I had to scroll until my wrist hurt. But there is one down here somewhere. There it is. 3 reasons you shouldn't wait to refinance your mortgage. Okay, there's one financial strategy we found so far out of all those tiles of spending-related decisions. And this is probably the best place for us to leave off. Now, I heard that little disruption. Are we still good on my camera? Or do we? Oh, we got thumbs up. Look at this.
Cool.
So
we do need to have a quick message from our sponsor today because we didn't do those.
Oh, Cory, why don't you do that?
Sponsor. Today, our episode is brought to you by Shepherd Family Chiropractic on Westlake in Seattle. Now, there was no specific financial remuneration for this episode. We're really against taking sponsor money for these, keep these very centered and nonpartisan. But we did tell my parents we'd be starting the launch right at 7 Central Pacific, and we were a little bit late. So they're starting their day at Shepherd Family Chiropractic. So thanks for tuning in. Sorry we were a little late, Mom and Dad. And
by the way, as a side note, and a new promotion that I just created and haven't run by Cory yet.
Oh dear Lord!
If you are one of our first attendees for the YouTube live stream, we will promote your business just like we just did for Cory's parents. It could be you in our next live stream 2 weeks from now.
I love it.
Jordan is losing his mind over here. He fell out of his chair.
The first business name to be chatted in our live stream gets promoted that day. I love it. I love it.
I love it too, but let's just be clear. If you have a business with a wildly inappropriate name,
we
Cory,
reserve the right
Cory will not say it.
I'll let Paul do it.
Yeah, of course he will. All right, so here's kind of where we want to leave it today. And this is something that we forgot to do in our last live stream. We were so enamored with the equipment. But getting back to something we promised to do a little bit earlier this year, which is we're creating a catalog of the way that Cory and I think about things, the way our guests think about things, some unique insights that we can garner. And what I want our kids to think about from either the unique insights we get from a guest or time that we spend with one another thinking through some of these financial topics is that no one has your future in mind when they create an offer. No one has your future aims in mind. Now, that sounds kind of heavy, and for some of you listening, this could be heavy. I mean it to be very heavy for when my children listen to this. But everybody creates an offer based upon their aims. And they don't have a direct interest in whether or not it helps you with yours. When they create the new Mercedes and roll it out and some new feature that makes last year's feature obsolete, were they thinking all about the aims of their clients that bought the cars last year? No. Were they thinking about the aims? I think this is some years old, but I think Mercedes did some kind of study that 70% of all the people that buy their cars, it's not financially responsible for them to do so. Like, wow. These it's prevalent all over the place. And that's why what you have to do is check for where your interests align with people. Based upon what this tool is going to do for me, will it help me meet my aims? Will this coaching program I'm considering help me meet my aims? Will it care for my family in the long run? Will this financial advisor, are their interests aligned in a way that they can allow for my aims to be met while they meet theirs? Because at the bottom line, nobody's out there doing pure charity work. And if they were, you should worry about taking their help because they also have no vested interest in it working if it's just charity. You see, what we have to do is think about what's important to us and our future and our finances. That's why we talk about we need to design and build a good life. It takes design. It takes reflection. It takes purpose. It takes having a stake in the future and saying, this is what's okay with me and this is what's not. There are many people driving some slamming cars that pass you on the road today who will be living with their children in their old age. There are people with some amazing houses that you see, as you drive down the road and think, man, would I love to have that? And the financial stress that it's putting on them is going to lead to a divorce. And all of the people that participated in those transactions were just looking out for producing the outcomes they wanted for their business. And so my encouragement to all of you, and certainly as Cory and I have these messages that kind of relate to our offspring, to just keep your aims in mind with every transaction you're going to encounter. And whether or not this new thing you're going to deploy money, energy, or resources into actually leads you closer to where you want to go, because nobody on the other side of that transaction takes your future on as their responsibility, not the person writing the article, not the person writing the book, you. And if you want an interesting podcast on that, just search our podcast for Being Your Own Fiduciary. And it's going to give you some insight about the way that we would encourage everyone, including our own children, to be primarily responsible for your financial future. You can't completely outsource it to somebody else. You can hire a household financial officer with someone like Sound Financial Group, but you have to be responsible for those outcomes. Cory, another successful live stream in the bucket. We are so thankful to all of you for coming on and joining us. Remember our promotion? First business to end up in the chat probably gets a shout out, unless I don't like you. And with that, we hope you guys have a great rest of your week. We're so glad you could join us here on Tuesday morning. Be sure to like, be sure to subscribe, be sure to find something interesting in one of our videos and share it with a friend. And as always, we hope that this has been a contribution to you being able to design and build a good life and upset, thwart, and prevent the ills of big box financial retail from impacting your future. Have a great week, everybody.